All right, sink or swim. 1, 2, 3, 4, 5. Yes. Excellent. God, that was weird. It's very annoying. All right. So where were we? Oh, yeah. Well, look at the big picture here. If we can get that to load. Ooh, oil looks sad. All right, these are mostly 10-minute charts. These are all 10-minute charts, it looks like. So you have about 3 days laid out here. So really nothing. I mean, we had the big downturn on Monday in the morning, and we struggled to get back to here, and now we're basically struggling just to get back to the same place. We're not doing anything. These are sad, sad charts, but the Russell is the real concern here. That rejection at 1050, we'll look at the bigger picture in a minute, is really bad. Nikkei rejected 17.5. I think the DAX was rejected at 10,000. Now, to some extent, we have a strong dollar, but it's not that strong. Well, it is strong. For us, it's up 1%. So that kind of puts 1% pressure on the markets to the downside. So you have to forgive them a little bit for not being strong, but they should be able to shake that off. That's not good. Oil is just completely collapsing. Look at that. That's just 2 days. 36 to 32. That is really bad. Natural gas 228. Now natural gas is cascading down. It's hitting the support, but that's where that S2 line is where it should stop falling. Anything should stop falling by S2. Here's oil falling to S2. That's strong support. Very few things move past 2 standard deviations in 1 day. So you certainly expect some support there. That doesn't mean it's done going down, especially because unlike oil, it's not bouncing off of S2. It's just resting on S2. So that's not a good sign. So, although I want to buy at 220, I'm going to, we're still going to play it by ear and see what happens. And again, I'm more scared in natural gas of missing the boat to the upside than I am of getting in back in at 220 or 225. But I don't know. I mean, it's been so volatile and disappointing and so obviously manipulated that they could spike it right back down again just to try to shake the last of the people out. Because don't forget, I mean, if it goes from 220, people go in at 220 and it goes back to 180. That's bad. That's a 4,000 per contract loss. You don't want to lose that, right? That's very annoying to lose that kind of money. So they could really sort of discourage a lot of people from staying long in gas by doing something like that. So for now, if you must buy gas contracts, UNG is probably the way to go. Look at TLC zooming up there. People panicking the bonds. Banks are out of favor. This is getting a little bit more interesting. XLF. I think it's in a butterfly portfolio too. Apple, not quite 100, but close. Tesla, a little out of favor. Netflix coming back. We sold 120 puts, so we don't mind that they're coming back up right now. But we also have longer puts that we want them to go down eventually. Amazon, annoying, but certainly learning its lesson slowly but surely. Win, still out of favor. We like them though. I love that put play we had from a while ago. Right before Christmas, I know I had this a put play selling the puts on Win long term. They are great prices. Anyway, so things are not terrible. I mean, look, compared to what they were a week ago, this is great. We're not diving, but this is really bad with the Russell. This is incredibly bad. Let's put that away for now. Your CL chart is behind. I would think not. Just sink or swim. Oh, no. You know what it is? Because the elevator here is over here. There. That's why. He was looking at it a few days ago. Either way, it looks bad, right? It's the same bad chart either way, so it didn't matter. Anyone else like that? No. Okay. Good catch, Cal. All right. Let's see. Questions? No questions. All right, so I can just blab on. So let's see. Things look worse at the bottom. I suppose. Yes, it wouldn't look best at the bottom for sure. Indexes. Hourly. Okay, so in the hourly charts now. So, well, no, actually, the hourly's not going to cut it. We got to look at the daily view. So it's funny, isn't it, right? Because in the hourly, you could fool yourself. That's why you always got to go back in time. Because you look at the hourly, and you're like, oh, look, we're recovering. Isn't that nice, right? But then you look at the daily view, and you're like, it's like in it's like in that movie Ant-Man where they're having like this massive fight, and then they pull back. And they're actually on like a toy train track where these guys are having a fight on a train. They're shooting each other and throwing things, and stuff is going on. All of a sudden, they pull back the camera, and it's like a little toy train track that they're fighting on, and it gives you like this perspective of like how insignificant the whole thing is. And that's kind of what this is. This bounce is really not significant, is it? Right? You can't even see the bounces when you pull back to the hourly view. So, not because the only thing that had a good bounce was volatility. Panic bounced very nicely, but nothing else. So that's very sad. So these things will look like a big recovery, even the DAX. Everything looks like it's coming back, but that's why you got to get your head out of those short-term charts most of the time, because they really don't give you a good view of what's happening. You go to weeklies, and here's the other thing, though, even worse. You look at the weekly chart and you say, whoa, we're not even at the bottom. We've been worse. The Russell's at the bottom and challenging like the way low from 2014. But we could be worse, and the VIX could be more panicked than it is now. Okay, we were more panicked. We were more panicked just a week ago with the VIX. A week? That doesn't. Why is this chart not the same? It says weekly, but this clearly is not weekly. Oh, no, I'm sorry. This is the beginning of 2015, so this is weekly. So it's not a week ago. The beginning of the year, last year, that's what this is. So the beginning of last year, we hit all the way to 30. That's pretty high, though. So the VIX was really panicked at the beginning of last year. We're coming back. That volatility is coming back. Now, we love that. It's fantastic opportunities for us to sell options. But, this is what you have to realize. Now, let's pull back to monthlies. And look how far we could drop. From a purely chart perspective, I'm not saying we're going back to 2011 levels, but, you look at it from a chart perspective, this isn't even a big pullback. Europe had a pretty big pullback. We haven't had that kind of pullback yet. DAX is pulling back. So what did Europe do? Europe came back. Well, here's DAX is easy to see. 12,000 to 9,500. That's like 2 into 12 is 1 into 6 is 15. So 15 to 20% range on the pullback for the DAX. Okay, we're nothing like that yet. The Russell's only a little bit past 10% now. So you think 15 to 20%, you're talking about 850 on the Russell. If you're looking at 3,200 NASDAQ, you're looking at 1,450, 1,500 S&P. You're looking at 13 something on the Dow. Maybe 14 will hold. So if people start panicking, see, that's the thing. If people start panicking, value doesn't matter. What matters is the chart and how far the chart can go back down. Just like in 2008, there was clearly no rationale for the prices of many of those stocks. They were ridiculously low. That didn't mean it didn't happen. And that's the thing. And here's what's happening now. Legitimately, Arch Coal just went bankrupt, first of all, right? That's the second biggest coal company in America. So if Arch Coal goes bankrupt, then why would any other coal company not go bankrupt? Then why would any other, this is what panic thinking is like, then why would any other energy company not go bankrupt? What about all these E&P companies? What about all the banks that lent them money? What about the copper companies? What about the gold miners? All these, as soon as one guy who's big goes bankrupt, just like with the Lehman thing, everybody freaks out. And even healthy companies can get in trouble because nobody will lend them money anymore. And nobody wants to do long-term business with them. Nobody wants to trust them to do stuff. Nobody wants to get into a contract with them that obligates them for long-term to a company that might be in a shaky financial position. It makes it hard to do business. Nobody wants to come work for you if they don't think you're big. Nobody's going to leave IBM to go be an engineer at an oil company because they don't know that the oil company is going to be in business in 5 years. So the oil companies have trouble getting quality employees. The miners too. All these people who need, they have some need of tech kind of people. Those people aren't going to run over there and help them. It's not all about money. I mean, when you, excuse me, still have that cough. When you go to switch a job and you're going to go move across country and stuff like that, you look into the, if you have a high-paying job, and most of you guys do, you look into the health of the company. You look into you look at the prospects. You don't just go and take a job. You think about what kind of job it's going to be and what the career path is and how it's going to work out. You look at like Canada with the oil sands projects. They're shutting down. There's a huge portion of Canada just shutting down. Towns are closing up all over the place. The repercussions of that in a small country are huge. So their whole mentality turns very sour, just like, when we did in the Depression, right? Like when the Rust Belt, we had the Rust Belt issue, we had the farming shut down, all that. Oh, and by the way, it's a terrible, terrible year for crops this year. There's enough crops, we're fed, but there's the prices of crops, the agriculture, where are they? Soft. I don't know, grains. Well, all right. This is monthly, by the way, so this is monthly. Look at cotton. Poor cotton, right? Coffee? Whoa. Good for Starbucks. What the hell happened? Coffee from $3.50 to $1.15, yet Starbucks keeps raising their prices. Sugar. It ain't the sugar. Sugar went from 35 to 14. These are monthlies. These things are just not recovering. Lumber, also lack of housing, right? Lumber's in the toilet. Also, almost 50% drops in this stuff. Cotton, 180. Well, that was a peak. You argue 180 shouldn't have happened, but 180 back to 60. Now you look at some grains. Corn dead, soybean dead, oats dead, rice dead. Now it's interesting. Remember in 2008, rice spiked up and caused a problem. Now it's a lot better. It's weird how many different kinds of soybeans. Soybeans. So edamame is a special, like everywhere I go now. It's really good. Wheat and wheat chaff. This is why we have no inflation, because all this stuff that we make things out of, here's metals. All the stuff that we make stuff out of, here's meat. Now, meat got kind of expensive, but it's coming down. It should be coming down because, everything the cows eat is cheap. Right? So it's the cost of raising the cows has gotten cheaper. There was an issue with the cattle, though. I guess because of the droughts or whatever we had a while ago, they slaughtered a lot of cows early, which dropped the price for a little while. And then there's less cows to breed and so on and so forth. It's a cycle. That was back here. That's why we have this spike. First you go down, and then you have a spike up because you killed all the cows, flood the market with meat, and then there's no more cows for breeding, and it goes back up. This, by the way, is one of the easiest things to bet on when you find out that's happening. When they start having these dips in the cattle market, then they always come back. But it doesn't happen very often, of course. All right, so that's good. That's monthly. But see the weakness, the incredible weakness in the grains and the meat and the metal and the soft goods. Everything we consume is cheap. I was encouraged because England is pushing to start infrastructure projects. Finally, somebody is getting the message and figuring out, like, look at this. We have all this surplus labor, and we have all these cheap materials. Wouldn't now be a good time to start some infrastructure projects, right? So it finally occurred to England to get going on that, and hopefully it spreads. Hopefully Europe picks it up, and then we start picking it up, because we're woefully behind on that sort of thing. Could the weakness be due to options closing in 2 days? I would have thought we would have popped back up. I would have thought I would have thought that we'd pop back up for the options expiration. That because the people who want to sell the next set of options want to have good prices on the stuff that they're still stuck with. They want to lock in those prices. But there's still tomorrow. I mean, I don't know what happened. I really don't. I don't see any specific thing that knocked the market down the way it did. Let me check some. Let me take a quick look at the news just in case I missed something. It was right at 11:30, right? We started. No, it wasn't. It was earlier. Really, on 10, we started falling apart. And at 10 o'clock, we got the JOLT report, which is the jobs report. There was in line. There was nothing to it. Seriously, nothing. I think this is oil. I mean, honestly, I think this is oil started selling off right at the open of the IMAX. At 9 o'clock, oil started selling off sharply, and I think that knocked down the energy sector, and that took the Dow down, and then everybody else followed. Not any particular thing that went bad, just more of the same, basically. What do you think where dividend aristocrats will go in the next years? I think dividend stocks are the good dividend pays, the strong ones, the blue chips. I think are it's always better to have them than not as far as it goes in a downturn. But honestly, I mean, I'm very nervous that I still, we haven't made many acquisitions yet. We haven't used much of our cash because I still don't know that we're not going to drop another 10 to 15%. And it's not like the dividend guys will be spared, but it's just that you're better off because you get the dividend, and they usually lose a little bit less than everyone else. When there's a really steep sell-off, one of the first things I like to do is go for the dividend-paying stocks because those rarely go on very good sales. Oh, IMAX trading the OOP. Yeah, well, again, it goes back to we were a little bit weak, right? I would honestly love to do IMAX, but IMAX isn't weak. IMAX is up 2.5%. I guess you shouldn't have said anything. Me and my big mouth, right? I said it and I didn't make the trade. All right. Well, I don't like to make a play. Let me see. All right, let's take a look at where IMAX is. So what we think is going to happen is IMAX is going to run back to here. The Chinese news is huge. This is their biggest opening by like a 50% plus more money in Star Wars in China than they've had on any opening weekend. And what we're seeing in America, this is like week 4 and still the #1 movie. We're seeing in America is like Avatar, it's sustaining. Which is what happens like Titanic and Avatar. The reason they made $2 billion plus is because they sustained their box office a long time, more so than having one blockbuster weekend. It's about what are you watching a week, 3 weeks, 4 weeks later? Because most movies trail off very significantly. Now, obviously, Star Wars did too. It went down like 80-something million this weekend, which is nothing compared to opening weekend, but it's still a lot of money. I mean, for any other normal movie, it would be considered a great open. And that was its 4th week, or 3rd week, whatever it is. So, and China, of course, starting now, and they open up with not a record for China, but a record for a domestic for an American film in China. And IMAX, by far, they blew it out. I believe they had $8-something million worth of income from Star Wars, and the previous was $6. So a huge beat. Anyway, so those numbers will come in, and of course they also have the U.S. revenue, and there's a whole bunch of other big movies coming out for IMAX, so lots of reasons to be long on IMAX. Let's take a look at them. IMAX. So up 2.5% today, because I had to mention it without doing the trade. See this right off the bat, boom. Let's look at the income. See, very flat. Their revenues are generally flat. They're not making a big amount of money. So that's not an exciting stock generally. And where is IMAX? They have been pretty flat for the last few years, and right around 30. So I like this spot. But the thing about IMAX, if we look at their forward-looking estimates, all this investment, see, current year 109, which I guess they're expecting a big 4th quarter, but current year 109, so they're expecting a huge 4th quarter, and then next year they're expecting continued improvement to 124 share. And for a company growing that nicely, that is good money. So I don't think they're going to go huge, but I think they're going to come back to about this 35, 36 line. Probably soon, probably March. They've got earnings in February. So the trade on IMAX would be, so we start with the premise that we don't mind owning them long-term, IMAX. So if I don't mind owning them long-term, and they're $33 now, and I can sell they only go to 217. I can sell the 217.30s. The bid is 265 and the ask is 380, so let's call it 320. Well, no, let's check that, because here, boy, it's hard to tell. Well, he's 450, and he's only $2 less. Yeah, I'd say 320 is very fair. So you can sell these $30 puts for 320. That would be step 1 of the trade. I got to write that down, though. Because this is the way we'll do for the options opportunity portfolio. We're going to do IMAX. 320 for the 30 puts. And let's say we sell 5 of those, right? So we obligate ourselves to buy 500 shares of IMAX at $30, which is $15,000. Which is a lot for the $100,000 portfolio, but it's only $7,500 in margin. So honestly, it would be a big position, but not unmanageable. But because of that, though, we can now buy some bull call spreads. And I'm not going to buy them in January. We're going to buy them for, let's see if we can buy April, March. Is March too ambitious, do you think? No, I don't think so. I say 35 by March. So let's say we took the, no, we're not allowing for, if we do that, we're not allowing for market catastrophe. So I'm going to back up on that statement. Because if the market crashes, where's our escape? We can't, IMAX in a nutshell, IMAX in a vacuum, a nutshell is very different than a vacuum. IMAX in a vacuum is going to go up. But IMAX, if the entire market drops 10, 15%, is going to drop 10 or 15%. There's nothing magical about it. So we figure, say 20% would be $6. That'd take it down to 25. That would be that would be pretty much uncomfortable for if we did something with the March. It would be too soon. June would then be too soon to recover. So we're going to have to go more conservative to the end of the year. And what we can do is we can pick up these 28 calls, and I think the low end is fair. Let's say 750 for the 28 calls. Now we're going to take 28, 750, and let's say 35. And 35 look like $4. Okay, so if we buy the calls and we sell the puts for 320, so we'd be selling the $30 puts for 320. We're buying the 28 calls for 750 and selling the 35 calls for $4. Sorry, and that's like net 30 cents on the spread, right? Sell the 28s, 5 each. Sell the 30s, buy the 28s, and sell the 35s. So then you've got a $7 spread that you paid net 30 for. And we can get back $3,500 on the trade. Now don't forget, we're committing to own $15,000 worth of IMAX, but we're still making 20% by the end of the year, even if we have no margin at all. But in any kind of normal margin account, in fact, here I think I'm going to show you what it looks like. You sell the puts, and we're going to sell 5, and we're going to sell them for $3. No, what did I say? 320, right? Yeah, 320. 320. Okay, and Thinkorswim says $1,200. See, $1,300. So your buying effect, your margin effect is only $1,300. That's all you really need for the margin. So if worse comes to worse, we're not going to cry if we end up owning IMAX long term as a 10% of our portfolio, basically. So that's our worst case scenario, is we end up owning IMAX. In the better case, though, all we're doing is putting aside $1,200 worth of margin. Another 350 times 5 is another $1,500 on of cash laid out for the spread, and that's it. And then the upside is $7,000. So that's what we call margin efficient. We're going to make way more money than the margin we're using on the trade. So that's going to be the trade for the option opportunity portfolio. Let's see, back to the questions. What's your take on oil considering the recent destruction? Brain's not working today. Well, I've said for a very long time that I think oil is going to go down to as low as 25, and that it's going to bottom out in January or February. So here we are. If it goes low, anything getting near 27.50, I'm going to start buying. And what we start buying is, I always get it mixed up. Is it UCO? SCO? Can't be SCO. UCO, right? Is it long? Yeah, so UCO is the ultra long. We played that once before. In back here when it was 17, you took it and you had a nice trade. Now it's like, what is that? 837. It's like a joke. Because it's an ultra, and ultras perform so badly when something goes relentlessly downhill. Ultras just completely fall apart. This thing gets down to like $5. How could you not want it? First of all, look at the options on it. UCO. I think it's a 2 times ECF. Actually, that's not a very good price. You can't. The the short puts aren't really worth selling, interestingly. I'm surprised. February, let's see what July looks like. That's where we'd be targeting July. $1. Okay, I wouldn't mind selling those. If you can get $1 for the $6 puts, I'm not saying now because it's not low enough now. Excuse me. Well, especially if we can get $1 for the $5 puts, I'd be real happy. So I would be okay about selling one of these for $1. And then on the pickup, we'd want to go with like the 6s here are $3.50, and what can you sell for $2.50? 9. So you take the 6-9 spread for like $1.30, right? And you sell the 6s for $1, and you end up with 30. Now you got 30 cents on a $3 spread. You can make 10 times your money back on the spread. And again, I'm not saying do this now. That's not now. When oil hits when oil hits the mid-20s, I wouldn't mind starting position. And if that got worse, here's the thing about it. If that got worse, I don't mind pushing the position. Because ultimately, I think oil will come back. Ultimately. Maybe not this year, maybe not even next year. But ultimately, I don't mind owning oil for $20 a barrel, long term. And we're not buying, when it goes to like $7.50, and we sell the $6 puts for $1, that's $5, right? We've got another 30% down, which is 15% further down on oil, which from like 25 would be $4 more, like $21. So, this is the thing about the way we like to discount our sales, right? Because I'm not putting my foot down at $25 oil or $27 oil. I'm putting my foot down at $21 oil by selling those $6 puts. So we're saying we don't mind being in oil at 21. And even then, what's $1 in 2017? In 2017, you're definitely down to the $5 puts, and maybe down by the time we do it to the $4 puts. So, we're getting even more. As we do a roll, we'll get even lower. All right? Now, realistically, though, it's very complicated. Because these things decay over time, if the trade went seriously against us, I would roll, this is complicated, I would roll from UCO to USO. Because you're going to end up holding it long term. You don't want to hold the ultra long term. You want to switch to the ETF, which also decays, but not as badly as the ultra. And so all you would do is then look in USO for a comparable hedge. Now USO is also horrible. It's at $9. But if you try to sell those July, so you don't get as much money. That's the thing. If you want to sell those July 6 puts, you're not going to get no $1. You can get 22 cents. So we don't want to do that. But if we went long term to 2018, we could sell the $7 puts or the $5 puts for $1. And so we would roll to the USO spread instead of rolling to UCO. Instead of rolling longer on UCO, because USO will hold up better over time and will come back eventually, maybe one day. And by the way, we talked about this the other day in chat. Long term, I've been saying this to you guys for a long time, and it's actually now maybe seeing it. But the problem with oil is the demand's gone, and it's not coming back. We're getting more and more energy efficient, and we don't need as much oil as we used to need. So how's it going to come back if people aren't using it anymore? When people burned wood for fire, to keep their homes, wood was a lot more expensive. In fact, people used to talk about peak wood. That was the thing. They talked about peak wood. They talked about peak coal. when we switched to coal, they started talking about peak coal. And then we switched to oil, and they talked about peak oil. Sadly, in like 40 years, we'll be talking about peak sun or something like that. Like we'll be using out. In fact, somebody said that already. Somebody in some Yahoo in North Carolina, South Carolina, they wanted to block a project, a solar project, because they were worried that we were going to use up all the sunshine. I mean, people are real stupid. So when we run out of sun, when we run out of solar power, we're going to have much bigger things to worry about than whether or not we can heat our homes or light fires or whatever. Suddenly, your tweeting will be less important when the sun starts running down. But I think that's about 5 billion years from now. So we got a while before that happens. But if you assume an infinite amount of energy use, which is also obviously not going to happen most likely, but we could conceivably use more, or we could utilize more solar power than any side of the Earth faces at one time. That could happen 1,000 years from now if we keep growing at some incredible rate in society and our energy use keeps going up. We could actually start using so much solar power that the surface of the Earth is no longer enough for us to satisfy our needs. So that's, we can worry about that later. And by then, hopefully, they'll know how to put it in space. And what's your take now? Or maybe it's up today. What? Boy, you guys. No, well, Diz is already in the options opportunity portfolio, so let's have one disaster at a time, right? Top trades for IBM, didn't see anything go out yet. Yeah, no, I was waiting to see how the market held up, and it's not holding up. So I got less enthusiastic about my IBM trade, too. IBM itself is down, so that's fine. I'm honestly not, well, if we look at the IBM, we can look at IBM. It's not going to hurt. This is not a call, though. I'm just looking. Well, IBM's easy because IBM is going to dip down. We know we want to own it one day, so here you go. You sell the 110 calls for $10, $10.50 here. All right, so you sell the 110 calls for $10.50. Now your worst case is owning IBM at $110, which you shouldn't have a problem with. If you're making the trade, you shouldn't have a problem with it, right? And then if you want to see where we're going to be with IBM, we're certainly going to be over 120. And let's see if that works out. So let's say we have $10 to spend. These things are $20. The 100, well, it's 21.26 is too much. That's not accounting for the drop today. So let's take 21.26 minus 62 because they're down. Well, how much are they down? $1.22. So probably $1 off that. So let's call it 20.25. So you got 20.25 here, and let's say this isn't bad. So you do the 100s are 34. So 34 minus 20.25 is 13.75. So you do the 100-120 spread for 13.75. You sell the 110 calls for 10. So now you're in 3.75 on the $20 spread. And all IBM has to do is not fall below 120, and you're going to get back $20 on your $3 investment. Now, this is going to be less margin efficient because IBM is an expensive stock. And frankly, this is why IBM lost out in the stock of the year. It really came down to, in the end, the fact that I couldn't make as good of an option trade on it. I looked at all this stuff. Whoa, that's not what I meant to do. Sell, IBM, blah, 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 okay. So so it holds $700 per contract. All right, so $7 per contract. So your margin on this is $7. Not bad. Don't think you're going to make 20. So you got $7 in margin plus your $13 in cash, $13.50 in cash, and you get back $20. So effectively, you get back 100% of cash in margin. So I wouldn't call it. It's not like margin efficient, but it's not a bad play. But there you go. See, when I'm making a stock of the year pick, I look at all that stuff. I say, can I first of all, for a stock of the year, it better have a real clear path to making 300 to 500%. Otherwise, I'm not interested on cash. All right. Now the IBM does. It makes 20 back on 350. That's good, but the margin's high. With the UNG play, that's a much better return on investment, frankly. And also, I was more more positive. I really couldn't see any conceivable way UNG wouldn't hit my numbers versus IBM, where you say, well, who knows, something could go wrong. It's a big company. Maybe Watson fails. Maybe they have to withdraw it. Maybe when they start utilizing it in a wide scale, it doesn't work out, or it's disappointing. You never know. Like Siri was disappointing when it started. Still is kind of disappointing, frankly. So you never know. So there's a risk factor, and there's the fact that I just didn't have as good of a feeling about putting together an option trade. And in fact, even now, I'm putting together a fairly conservative trade. Now, it's funny, the conservative trade turns $350 worth of cash into $20, but I'm putting together a conservative trade because I really am not sure when IBM will take off. Now, we're giving it 2 years to stay above 120, which I feel very confident in that. But we're getting better prices now because we got nice and cheap. That's also true. So when I was looking at it a while ago, I think it was at 140, and I wasn't getting these kind of prices. Now that we're getting these kind of prices, it's a little bit more of an exciting trade. So that is actually, I would in fact put that out for the top trade. Selling the 110 puts, buying the 100, 120 spread, and that would be a net of 350 on the $20 trade. So that one I do feel pretty good about the way it's set up. March seems early. What if we look at it? You guys, do you understand? You're completely out of context when you say these things. So I have no idea what you're referring to. So March, I guess you're talking about. Probably you were in the middle of when I was talking about the first one, whatever it was. What were we talking about? IMAX. So March is my time frame for them announcing earnings, giving positive outlook and guidance for the year, and shooting up. The only reason March is early is because I'm worried about the market turning down, so we went with 2017 instead. Easy enough. Alistair says, knock the market down reasons equals no good news. You know what? I agree there's no really good news, but I think also there's not that much. There's no new bad news. It's all the same crap being sort of rehashed over and over again, and it's not enough to me to make me not think that we're going up from here. In fact, that's, we are actually in the option opportunity portfolio. We actually flipped pretty bullish, and the short-term portfolio too. We took off all our hedges, not all of our hedges. We still have a good one on SDS, but we took off some of our hedges, and we took off all of our hedges in the option opportunity portfolio because I am calling a bottom here, right where we are now. And I'm a little worried about it because we're not really getting traction back. It's not looking easy, but I think we're going to hold this level. For now, I don't see China getting worse than it is now. I don't see Europe getting worse. I see some positive signs. There's some negative signs, positive signs. It's a weak global economy, but nothing we don't know about, nothing that isn't sort of baked into the cake. And at this point, I do think that earnings, the bar is now set low enough where a lot of people are going to come in with earnings and people are going to go, oh, that's not too bad. Except for the energy sector, which can be a catastrophe. The bearish views, the big investment banks are sheep. They just start making like I was bitching about 2 weeks ago. I was saying they can't find when was that last webinar we did? It was right before Christmas, right? So right before Christmas, we were doing the webinar. I remember saying, I was like watching the CNBC, and I was saying they can't find a single bear. And I was dumbfounded. I'm like, how could they not find anybody to say this market is overbought? All of a sudden now they can't find a bull. It's the stupidest thing. It really is. I had people call me up for TV stuff, and they say, do you want to come on the air and give a bearish outlook on the market? And I go, I'm not bearish. And they're like, oh, thanks, bye. They already have it decided what they want to hear. So, when they manipulate the news, it's not like they manipulate each person and each guest, but they know who the guests are. In fact, I was talking to a guy who tried to get on CNBC, and he says it's very hard to get on CNBC because they don't trust you, and they only want reliable people. This is why I had a program with them like 10 years ago about this stuff. They only want you on if you are exactly reliable, so they know exactly what you're going to say before you say it. So they like people who are just like, they love one-trick ponies who say the same thing over and over again. And whenever they need a bear on oil, they pick this guy. Whenever they need a bull on Apple, they pick this guy. They know what they're going to say so they can fit it into their little narrative. So, what was I going to say? Oh, yeah. So, they just decide that the market is bearish, and they only want to talk about bearish stuff, and they just load the guests up so that you think that everybody in the world is this or that. And the same thing goes with the newspapers and the articles and all that stuff. They just decide. The editorial policy goes, oh, we're going to be bearish this week, and all of a sudden, if somebody has a bullish opinion, they don't want to hear it. It is ridiculous. And that's what causes that investor fear. Because the investor, look, it's not the investor's fault. I mean, this is what they're telling you. They say in panic. I can't believe the crap I was reading this weekend about people with this and that bank coming out. Sell everything. What? Literally 2 weeks ago, they told you to buy everything. Now they're saying sell everything. And why would you listen at all? That's the thing. At what point do you say, I shouldn't listen to these people? They're not doing you any good. You got to think for yourself. You have to decide for yourself. You have to learn how to balance your own portfolios. You listen to these guys, they'll drive you nuts and they'll drive you broke. OSS, one of Zach's safe stocks of 2016. Okay, well, this is not the time I'm really going to start looking into something. I mean, this is it's like if we start doing suggestions of stocks, but they pay a nice dividend, but they're a small company. It's not the kind of company I would usually play. They got good revenue, they got solid earnings growth. They got a good PE. On the whole, probably it's a good company. Okay, I don't follow them, but I mean, it's probably a good company, and it's something to invest in. But you can't put a lot of money into a $100 million company. First of all, you end up owning it. So, I don't want to own 10% of a $100 million company and put a bunch of capital into it. But it's not a bad thing if you pick up some of this stuff. I'd say it's a good place to park. It depends on your portfolio. But if you have $1 million portfolio and you park $25,000, $30,000, $50,000 in it, not so terrible. But just make sure it's a risky play. It's a risky play just because they're small. And companies like this can blow up because any single bad investment people like this make can really blow them to bits. And I don't know what their track record is. I don't know the management. I don't know enough about them, so I couldn't tell you. But I'm just saying that's always a caution. People can have really good runs for years and look fantastic, and then they make one mistake and the company suddenly is not looking so good. So I don't know what these guys do exactly. I don't know what their business is. I don't know how they work. But, and the fact is Zach likes them is helpful, but it's not the be-all and end-all to me. I was asking IMAX or Diz into the Oats. We already have Disney in the option opportunity portfolio, don't we? Where are we? Disney right there, see? In Disney, we have a July 100 call. We sold the January 110 calls. Those are going to expire worthless. And we have the January 85 puts, so I'm perfectly good with that play. And IMAX we talked about going in, right? How do you defend IBM? I don't know why I would have to defend IBM. IBM is a great big giant computer company with diversified global interests, and they've got a new system called Watson that's going to generate quite a bit of revenue once they ramp it up. So there you go. That's how I defend IBM. I mean, how do you defend that? I mean, what do we have to defend them from? IBM says, here, give us $130 a share, and we will make, well, we're doing 92 billion. That's billion. Now they've spun off divisions and raised cash, so this is what they've done. They have still a good amount of debt. Let's see where they're at. So they have $9 billion in cash. They've got short-term investments, no short-term investments. With long-term investments with them, I'd say it's probably real. So they got basically the cash and debt balances out more or less. I don't know what other liabilities are. That's an iffy thing. But on the whole, look, they're fine. And you look at the cash flow for IBM. So, negative $2 billion. But that's because they bought $12 billion in their own stock. They've been buying their own stock like maniacs. So the negative cash flow is them buying their own stock back. They're using their cash to buy their company back. This year they calmed down a little bit. But on the whole, they're retooling the company. This company's in a turnaround, and you either believe in what they're doing or you don't believe in what they're doing. I choose to believe in what they're doing. I think they're doing very intelligent stuff to adapt the company for the times, just like they've had to do many times over their 100-year history. This company's been around a long, long time, maybe not 100 years, whatever. Say, 1924. So almost 100 years. So in the course of 100 years, they've had to retool their company. They used to be basically a typewriter company. They've certainly gone off that business. And I'm sure at some point somebody was like, "Oh, dump IBM, the typewriter is dead." Blah blah blah. You have to allow them to change, and you can't expect that every quarter that they're when you're changing a company this big, like Hewlett Packard when they turn that around. It takes time to retool a company and move things around. It doesn't happen overnight. You have to it takes years. It's like a battleship. It takes a long time to turn the thing. But also it's like a battleship. It's a very powerful thing. They're going to do quite well. Estimates going forward. Okay, $15 a share. This is $131 a share. They're making $15 a share. No improvement. Again, this goes back to what I was saying. Though. I didn't see that they were going to improve next year. They aren't going to improve next year. They're going to be flat. So I didn't think they're going to be a huge winner. But I certainly think that if they're making $15 a share and you tell me they're going to go down to $120, I'm going to be like, well, I think I want to buy that, right? I don't want to buy IBM with a PE of 8. I want to buy any stock with a PE of 8 if I think it's safe. And they pay a 4% dividend while you're waiting. And it's really, how do you defend it? How do you not defend it? Let's put it that way. How do you not want that? I'll say the top 10 line. RBS says sell everything. Yeah, a few people said sell everything. I had a couple of news items from that. B of A, I think B of A, UBS, one of the other, Credit Suisse, or one of the other guys out in Europe was saying just everything's like down on the whole market. And yeah, there's going to be, even if only 10% of their people actually believe it, even if only 5% of their people believe it, that's enough to cause a couple of days of selling in the market. And that's how they manipulate the market, though, these guys. They're the trusted advisor to a million people. And they put out a note that says sell everything. Which, is incredible. I mean, I did too. I said sell everything when we were at the top. I said sell everything. I said go to cash. So, it's not the concept of the note, it's the timing of it. It's like, why would you do this after a 10% drop? But it's probably because they think that we're going to have a 20% drop, or maybe more than a 20% drop. And there are plenty of people who are running around saying this is going to be just like 2008, the market's going to drop 50%. But it's not. And it's not because in 2008, the banks and the mortgage companies, which practically don't even exist anymore, mortgage companies, not the way they did in 2008, the banks and the mortgage companies had bundled trillions of dollars of bad debt and treated it like AAA paper. And when the housing market collapsed, there was no assets backing up the notes, and they effectively lost. They erased. This is from the banks, the mortgage companies, and the builders. All had ridiculously inflated assets on the books that had no actual value. And when it was discovered that they had trillions of dollars of fake value, and those dollars were removed from the books, it all hit the fan. And we had negative earnings on the S&P. And people had to mark down, it was paper losses, but it was, look at AIG. AIG must have taken $100 billion something hit. Fannie Mae and Freddie Mac, $100 billion, $200 billion write-offs. That's not going to happen now. The fake assets don't exist anymore. This is where people don't understand the mechanism of the market, and they don't understand why we have. Nobody reads history. Nobody studies anymore. Everybody just looks at the next 5 minutes. We lived through this stuff. How does everybody forget? Go watch The Big Short. That's helpful. It can explain some of it. But, there have been tons of books analyzing this and talking about it historically and what happened, what went wrong. Riddle's wrote a good book about it. But the bottom line is, look, we went into this mania bubble. And it wasn't just housing, because the housing bubble caused a commodity bubble. And oil was $140 a barrel at one point. And gold was $2,000 an ounce, or $1,800 an ounce. And copper was some ridiculous price that I don't remember what it was anymore. All this stuff went crazy. And everything was priced based on the fact that, and not just that, though, also, by the way, the salaries of realtors became crazy. And there are, let me think, in my town, I got 20,000 people, not 20,000, I have 2,000 people in my town, 2,500 people in my town, and there's got to be at least 20 or 30 realtors. So let's say 1 out of 100 people is a realtor. All right, so in the United States, there are a couple of million realtors, and there's probably a couple of million mortgage brokers too. And so you have 5 million people. This is one of the untold stories of the job losses, by the way. You had a couple of million people who were making obscene commissions on home sales. Not only were the homes selling for ridiculous prices, but they were flipping them constantly and refinancing them constantly so that there would be the same home would transact 2 or 3 times a year. It would be bought, it would be sold, it would be refinanced, it would be sold again. It was crazy. So, we're not going back to those levels. That's one thing I keep saying to people. You're not going back to these levels. It's like, this is it. We're at a normal level now. What we had before was crazy. You can't expect to bounce back to crazy. And since housing is so huge, such a big part of the economy, it just drives everything else. Lumber so it drove a boom in lumber. It drove a boom in materials, graphite. What was it else? So some other building materials. Things were just going crazy in prices. Copper, because of the copper pipes, was a shortage. Everything was nuts. And so everything goes up and up and up, and you justify it because you say, well, look at the houses, and then the people would make this money from the sale of the house, and they go out and buy another house, and this guy would buy 5 investment houses, and so on and so forth, and a builder would build a building, and people, this is what's happening in China now, by the way. What was happening in China is a builder would build a building, not a particularly good building, but he just built a building and he put it up and he charged $250,000 per 1-bedroom apartment or 2-bedroom apartment, and people would be lined around the blocks to buy them. They'd walk in with cash, and they wouldn't barely even see, sometimes sight unseen. They just go, oh, you're selling apartments in this neighborhood, we're going to buy it. Because it's a popular neighborhood. Is that happening now? No. We don't have that kind of bubble. The only bubble we have, or had this year, was China. And China was basically doing the same crap we were doing back in 2007, 2006. The same nonsense with the runaway housing market, the same nonsense with the unlimited lending, and so on and so forth. So China can blow up. It's not going to really affect us. You know, U.S. banks aren't lending into that crap. Their own banks and their own system will collapse. It'll hurt Asia's economy, but it's not going to derail everything. And it's already happened, by the way. Their economy has already ground to a halt. Their numbers are bullshit. All their growth numbers are bullshit. They're in a basically a recession at this point, and it's not going to get much better for a while. I mean, depending on how much money the government wants to spend, and the government is already papering it over, just like we did. We papered it over. The government and the Fed put trillions of dollars into the banks. That's why our national debt basically doubled since this happened, because we gave the banks all the money to cover the losses, because otherwise they all would have gone bust. And that's not happening now. That's not what's happening. There's no completely fake values. There's no this or that. You know, even in the same thing on the dot-com bust, right? Things are so ridiculously overvalued. There's plenty of overvalued stocks now, but there's also undervalued stocks. And on the whole, the earnings are justifying. The earnings were not justifying in the home builder space, in the mortgage space, and so on and so forth. Those earnings were never justifying it. And the projections were that we're going to double again in 3 or 5 years, and housing prices will be this, and the average family home will be $1 million. And nobody stops and goes, how is that going to actually happen? What are the mechanics of that? How does a person afford $1 million home when they're making minimum wage, when a family makes $50,000 a year in America? How do they buy $1 million homes? But nobody stops to think of this stuff while it's happening. They only after the fact they go, oh, that was silly. Meanwhile, if you're one of the, you know, if you bought $1 million home, you probably now understand why it's hard to sell $1 million homes unless you have a very, very exclusive sort of place. In fact, that's why it's like, you're better off buying $100 million homes than $1 million homes, because $100 million homes is only like, 1,000 people in the world who are going to buy it anyway, and they're always going to have money. Those same whether it's that 1,000 people or a different 1,000 people, but there's always the same 1,000 people who are going to shop for your home. And those kind of houses trade often. But if you try to sell $1 million home, you've got to sell it to the masses pretty much, and that makes it a lot harder. Especially with lots of them. But anyway, so that's not going to happen now. We're not going to have a 40% correction. We might have a 20% correction. We're not going to have a 40% correction. And frankly, like I said, I think this correction, which is getting on the 10% line right now, I think is enough. But that doesn't stop panic from setting in, and the press is jumping on the bandwagon and trying to panic people. In fact, oil right now is now $29, right? $29.99. Oh no, wait, 30. Okay, it was $29.93 a minute ago. So oil is testing a breakdown right here. Now, boy, if oil goes bust, I mean, then you do have a problem. You have an entire sector of the S&P that almost can't operate. But you know what? As soon as they start going bust, as soon as those companies start shutting down, that fixes the problem with oil. That's the funny thing about it. You knock enough of these guys out of business and they can't pump anymore. All it takes is about 1 million or 2 million barrels of oil to go offline. All of a sudden we have a shortage. It's not going to happen overnight, but, geez. It's a self-correcting problem, as commodities tend to be, a self-correcting problem. So that doesn't need any government intervention. You just let them go bankrupt, and all the marginal producers come offline, and suddenly you don't have too much oil. But there is too much oil. There's more oil than there is demand for oil, and demand isn't coming back. So the only thing you can do is reduce supply. And what Saudi Arabia is doing is they're keeping the prices low because they say, we're not going to be the ones that reduce our supply. They're like, no, we want to pump this much oil. We'll keep pumping this much oil. We'll take a loss for now, because rather than having... See, they look at this thing, if we have to cut back 1 million barrels of oil or 2 million barrels of oil, that's 20% of their revenues anyway gone. And it's 20% of their revenues gone, but when they cut back, the American producers and other country producers jump in and fill the void anyway. So the cutback is useless because more marginal producers come online and push them out. And then they can't even get their market share back because it got taken over. That's why the Saudis are doing what they're doing. They're like, no, screw you guys then. They're like, we can tough it out and we can put the marginal producers out of business so they don't cut back by choice. They're not part of the cartel. They're going to cut back because we're going to bankrupt them. And if they bankrupt enough marginal producers, all of a sudden there won't be more oil and people are going to be, hey, Saudi Arabia, please send us some oil. We'll pay you lots of money for it. That's what's going on right now. But, again, it takes time. It doesn't happen in 1 quarter, 2 quarters, 3 quarters, 5 quarters. It takes a long time to put people physically out of business. So that's the war that's going on now in the oil patch. And I think, though, this is the last quarter, because I think the earnings reports you're about to see in the oil sector are going to be shockingly bad. But already, for a large part, already priced in. We've already had massive sell-offs. These oil companies are already down in the dumps. It's not going to be a dramatic effect on the market, but the panic will set in also, and that could knock things down further. But then it basically becomes a good time to buy. And such a good time to buy that you can expect Exxon and Chevron and people like that to start buying up other oil companies. You know, they'll start, you know, picking up all the juicy ones that are for sale. So, was I even answering a question there, or were we talking about? Anyway, so that's why I don't think. Oh, that's why we're talking about selling everything. So that's why this is silly, because it's not the same. Now, I said sell everything at the top because I couldn't see a good way to defend against the drop. What we ended up doing was we beefed up our security on the short-term portfolio, hedged heavily, and we put ourselves in neutral. But the problem with going into neutral is we couldn't make money going up, and we couldn't make money going down. We're just neutral. So now, I've taken a chance, and we've removed our hedges in the short-term portfolio, or most of them anyway, and we're hoping for a bounce here. If we don't get a bounce here, we just have to add more hedges, that's all. If this breaks down here, we'll be adding more hedges tomorrow, mostly on the S&P and the NASDAQ, and we'll just rise down further, so what, no big deal. Also in the options opportunity portfolio, we'll have to scramble and add more hedges too, because that one's very unprotected. But I thought it was a worthwhile chance. It turns out right now it's not looking so good. But, you know, again, I only expect 10% additional correction. If we have it now in January, it might last into mid-February, but I think by March we're going to be back to where we are now anyway. And you know, to a large extent, it's going to depend on earnings and how the earnings are received. But the energy sector earnings, and we have to watch who's getting earnings. That's also important. The energy sector earnings are going to be horrific. The bank earnings, which come tomorrow and Friday, not tomorrow, Thursday and Friday, some of the big banks report, those are going to be mixed. The bigger banks, even the bigger banks will be mixed. But what people are going to be looking for is how much trouble are they in, how many bad loans are they writing off in the energy sector. Natural gas 227. Dying to buy that again. Anyway, so we will see what happens. But basically, so yeah, I mean, it's, you know, you can have this thing is just panicking sheep out of the thing. And if you want to be a wolf, then you just wait for the stragglers to come out of the gate and start picking them off, basically. And there's going to be a lot of cheap stocks. That's why we have a watch list, and that's why we're only slowly, once a week, we'll add another stock. You know, today we like IMAX. We like IBM. All right, but actually IBM's not even for a portfolio. We have something in IBM already. So IBM's not for a portfolio. It's just for the top trades because it's a good trade. IMAX is going to be added to the options opportunity portfolio. I think we added something to the long-term portfolio, but that was like earlier this week or last week. But, look, we have 800,000. How much? Let's take a look. Oh, wrong one. What's this? 5%. So in the long-term portfolio, whoa! Crap. Intraday, this thing lost a fortune today. That's interesting. I went from 30 to 22.9. That's pretty nasty. We have $889,000 in cash. But the puts, because the VIX shot up and all of our short puts jumped in value. So that represents all the short puts. So we dropped like $50,000 today. So the VIX shot up all the short puts in value. We didn't change anything. It's all the same stocks we had the other day. And it'll be better. Midday you get bad prices anyway, but because you're getting the worst of the bid and ask spreads during the day. But anyway, we have so much cash. We have more cash than the whole portfolio is worth. And we're just going to have to see what happens. Now, unfortunately, in the short-term portfolio, we're not going to get a big pop because we took off the hedges, 256, so basically where we were on Friday, because we took off some of our hedges. But here also, $411,000 in cash. We have negative 55,000 positions, but mostly cash. So we have, we still have $1 million. Isn't that weird? Why is that? So I thought there was not going to be, oh no, that's not right. 356, and there's less than $1 million now. So here's 356, and the other one was 640 or whatever it was. So we're now below $1 million. But we have, basically it's all cash. We have $1.2 million in cash with $1 million worth of value because we have negative equity in the positions that we're in. That means we have a ton of cash to deploy. But we're going to do it slowly. We're not in a hurry. We don't have to buy everything right now. Okay, we can buy tons of stuff. First of all, my top priority is going to be fixing stuff that we already have. If we have a position, we like a position, and the position is underwater, maybe we want to add to it, maybe we want to roll it, so on and so forth. All right, but again, I still think that we should be bouncing, and we didn't bounce today. We'll have to, and again, I don't see a reason for this, though. Other than these guys telling everyone to sell, I don't really see a reason why we're selling off like this. Oh my God, it's 220 already? Jeez. Crash was caused by fast 157. Okay. Investor sentiment: China fail, lower oil commodities, global slowdown, U.S. recession, lower stock market. Yeah, we know China's bad. Okay, it's been bad for. This is the thing. I've been talking about China for a year, more than a year. Just because, and yes, we may, and this is why I'm being cautious. We may be too early because sometimes it's, again, I'm already bored with China. I know it's bad. I know how bad it is, and it's over. That play is over. But not necessarily, because realistically, other people don't realize China's bad until they're being told by the media China's really bad. And meanwhile, but if China can continue to move back up now, everybody's going to suddenly relax and change their mind. And all of a sudden, everything will be good again on Monday. So we'll see. I mean, there's no way to predict where it's going to stop, but I think this is, we took a chance here to see if it turns around. If it doesn't turn around, we might take a $50,000 hit in our portfolio, and then we'll have to, but again, it becomes a buying opportunity. So I don't mind taking a $50,000 hit if the market goes 10% cheaper. So if the market's 10% cheaper and I lose $50,000 out of $1 million, I get to buy stuff. I'm happy. Where do you like long on SIM? Why, are they selling off? CIN is one of our favorite REITs, but the whole REIT sector sells off at the same time. Oh, well, down around here, under 13, 1250. But again, it's a panic issue, so you can't say it's nothing. Nothing's going to hold. If you buy CIN, you buy it because you want to get the steady dividend. The dividend on SIM is what? The dividend is $2. That's 14%. It's $2 on a $13 share. So you don't buy CI and you don't worry about the stock price. You buy Chimera, you hold on to it, and you keep collecting your $2. If it manages not to go bankrupt for 6 years and you keep getting your $2 back, then you have free stock. That's without selling any options or anything else. So that's why you get into Chimera. So far in the long-term portfolio, we've had it for, about a year or so? So, where is that? Wow. It's so volatile during the day. I can't believe it. Literally 7% since, when did we look at it? Didn't I look at it yesterday or Monday? Like 7% down. That's crazy. But it's because, look, all these are short puts, 27 short puts. And they flew up in price, which is against us, of course. All right, so Chimera. Here's our Chimera. We have 1,000 shares. It's very small anyway. We have 1,000 shares. And we bought them back on May 18th, so we haven't had them that long. But they pay a wonderful dividend, which is great. That's all we really want out of these guys, just keep paying the damn dividend. But we don't take a big risk on it. I mean, it's not in this portfolio. It's what, $14,000, $15,000 worth of the stock. It's down a little, but we don't care because we're in it for the dividend. We're in it to pay this thing down. So down the road, we'll have, well, frankly, I mean, we're happy to be assigned at a lower price. We sold the June $14 puts. We'll roll them, of course. But if we end up with 2,000 shares, that's fine. If we eventually end up with 4,000 shares, that's going to be fine too. Because as long as they don't, really fall apart. If we own 4,000 shares and we keep collecting, what do we collect here? We collected $2 on puts and calls, right? So we sold the June puts and calls, so that was 1 year out. So in 1 year we collected $2 selling the puts and calls, and $2 we're collecting on the dividends. That's $4 off of $14 stock, a $14.50 stock in 1 year. So in 1 year we go from $14.50 net to $10.50 net. Next year, we sell another, so it's as of June, which will be the first year. Next year, we get another $4 back. So by June of 2016, our net drops from $10.50 to $6 or $6.50. Then the next year, in June of 2017, our net is $2.50. All right? So in 2018, if we keep moving along this path, the stock is free, and hopefully we won't have 1,000 shares. Hopefully we will have 2,000, 4,000 shares at net free. Net free is a good price. And then we'll be collecting our dividend for nothing. And ultimately, that's what you want to do. And that's why we've left the long-term portfolio. If we were closing it, and I realize that by closing it every couple of years, the problem with closing it is that nobody sees what actually happens long-term. And long-term, this portfolio is going to be full of stocks that pay you a dividend for nothing, that you've taken all the cash back out of the trade, yet you still keep collecting your dividends on a regular basis. And that's how you can really retire. And you can do that with an entire portfolio of stocks over the course of 20 years. So that's what I'm trying to teach people now. All right, a couple more questions and we're going to be done. We are below the doom level. Yes, we are below the doom level. And how long before we get bearish? Tomorrow. Seriously, tomorrow. We are going to have, that's why I was waiting until tomorrow to do the position updates. But seriously, tomorrow, if we are not turning around, we are going to have to take some very aggressive hedges. Because this is bad. And we're right on the precipice of falling another 10%. And if we fall another 10% quickly, then you can get some real panic and we can go even lower. So, I'm still very much sitting in cash, very much staying on the sidelines. Don't want to take any big chances. The biggest chance we took, and by the way, there's a reason for it. The biggest chance we took is we took profits. After a 10% drop, we took the profits from our initial hedges off the table. But all we're going to do is, if we miss 2% of the next drop, that's okay. But all we're going to do now is put more hedges on the same way. They're going to make the same kind of profit. So the same thing that took our short-term portfolio up $100,000 in the last 6 months, because we were bearish from the top, it's going to take it up another $100,000 in the next 6 months if we drop another 10% or more. I'm not worried about that. In the long-term portfolio, well, it keeps losing money, but we're going to keep buying. Like I said, look at CIM. We're going to keep buying more stock as it goes down. We like to buy stock when it's cheap. So that's what we're going to be doing tomorrow also, is reviewing. It'll probably take 2 days to do all these reviews. We're reviewing all of our positions and saying which ones do we want to put more money into. So before we go buy new stuff, let's see how much money we spend on our old stuff. Because we have really good positions that have gotten a little bit cheaper. Yeah, the market is all oil. You know, he says moving up with oil into the close, Rob. It's all about oil because the oil sector is just freaking people out right now. And if oil goes much lower, you're going to see a wave of bankruptcies in the energy sector. Then that's going to spill over into the banks. And people don't like that. Having just come off a big bank panic, we don't like that idea. But again, it's not because I think that that these companies that we own, you know, look. Well, forget them. Not them, but you know, we have a short on Netflix that's up 15,000, so that's good. We have AA, we have Anthem, we have Sotheby's, we have BP, we have CCJ's uranium, we have China Mobile, which is amazingly holding up very well. We have Cleveland Cliffs, they're dead for now, but you know, long term I'm good. CMI, DBA, the agriculture ETF, Encana, Exelon, Experian, Gilead, Harley Davidson, Intel, coffee futures. We think that'll come back one day. I mean, not today, not tomorrow, but it'll come back at some point. And we're basically, look, we're like even on this thing. We'll have to roll this already, but we're even on it. Coors, Mattel, Manitoba, Mylar, Seagate, Stanley. There's 2 targets. We like Target. We got Whole Foods. We have Wynn Casinos. This is one we just did. Oh, and look, it's losing already. See, I like this one a lot. That's selling the $45 puts. Now they're $11.85. That nets you in for what? $33. They're at $55 now. You can net in for $33 with this play. Love that. We have Seadrill. They'll come back one day. We have an Armor REIT, Chimera REIT, Canadian Bank. Oh, this Canadian Bank is a great deal also right now at this price. Starwood Properties, we like them. That was the new one we just added. Oh, there you go. There's the one we added this week. We had, last week. We had Starwood last week. Apple, Barrett Gold, Aeropostal, Baker Hughes, Broadcom. I'm really having trouble finding ones I want to get rid of. Broadcom, we're waiting for the buyout to finish. Coach, Genworth, IBM, iRobot, Lumber Liquidators, another REIT, Northstar, OIH, long-term, RIG, long-term, Silver Wheaton is a silver play, we like them. Taser, Time Warner, that's another merger thing. Twitter, bad. Twitter, very, very bad right now. UNG, that was a good one. Should be able to have more of that. Walmart and Yahoo. So, you know, I mean, Yahoo's a little scary. Twitter's a good example of one where if they keep getting lower, I want more. Well, it's just so amazing. They've got 600 million or something users. It's one of the most popular things over in the world. It's so hard to replicate something like that, and they're just having trouble monetizing it, but they'll figure it out. And if they do suddenly hit on a way to monetize it that makes sense, the thing will double like overnight. You know, as soon as they roll out something that actually works and monetizes what they've got. And it's amazing because if they were a pre-revenue company, everyone would be giving them a break and giving them like a valuation of like, you know, 50, 60 times. But as they stand now, Twitter This is the amazing thing about them. They've got a 4P of 34. Let's see what they're estimated for. So they're earning 50 cents a share, and they're only getting 20 bucks. So it's not even, or 57 a share. So they're only getting 20 bucks. So it's like it is 35p, 36p. But that's up from 14 cents last year, 36 cents this year. Look at that growth. That's double, and then almost double again. And yet they're being considered a failure. Amazon makes a little tiny incremental amount of money, and everybody gives them, and everybody treats them like they won the World Series. It's weird. It's just weird what people like decide is in and out of favor. It really is. So I like Twitter anyway. It's good value. Yeah, and China's a 3-year low. The entire energy sector is a low. I'm so tempted all the time to buy energy stocks, but we have too many. You know, we already loaded up on energy materials, so we have to not buy any of those for the long-term portfolio, so we maintain our diversity. All right, last question. Phil, being bearish, when do you choose an SDS spread versus buying an SDS call? Is the spread usually the way to go? Yeah, we way prefer the spread because there's all kinds of great ways we can roll the spread and use the spread to our advantage. You get better leverage with the spread. There's almost no chance in which we want to just buy the stock itself. Are you saying buying a call? No. The only time I want to buy a call is if we think that it's going to make a very short move, a move quickly, and we want to sell it on the move. So in other words, we think it's going to move up and then drop back off or something like that. We don't usually do that. We did on SQQQ with the NASDAQ, because the NASDAQ is so led by Apple, when Apple hit our target, we pulled the call part of our SQQQ trades with the 5% portfolio. Hang on. Oh, lost 5% while we're sitting here. You can't go by these intraday prices, though. Anyway, we had the 15-20 spread, and we cashed the 15 for about 540. So the maximum on the spread, in other words, if we kept the spread, the most we would have made is $5 on this $15 call. So they went to 540, and we cashed it out. That's more money than we would have made by having the spread if we sat on it. But the risk we take is that, to some extent, this can be over 20 in March, and then we'll have to pay the extra. Right now it's at 22.81, so these things are worth about $3. They're being billed to us at $4, so it shows a bigger loss than we would have otherwise. But we think that by March, it'll come back. Why do I think that? Because Apple leads the NASDAQ around by the nose. Apple bottomed out exactly where we thought it would bottom out, and now Apple's going to come into earnings, and we think it's going to have another beat, and it's going to pop back up. And then the entire NASDAQ is going to breathe a huge sigh of relief, including all the Apple suppliers, and all of a sudden the NASDAQ will be back with SQQ under 20. And we won't have to pay this guy a penny, but we'll keep our 540. So that's why we took the money off the table. Because if SQQ ends up at 18 in March, we would only get $3 for our $15 calls. This way we got 540 off the table, which is the most we thought we could get for the spread. And now we've got these short calls. So we've basically flipped 100% turnaround. That's why we took such a hit in the option opportunity portfolio in the last week, though. We took this big hit because we have a $6,500 loss on this one position. That's a big loss. But if all goes well, that $6,500 loss will turn to zero. So that's the kind of stuff that we're looking at. So these things are kind of tricky. They're tricky to navigate, but you know, you have to, at some point, you've got to call a turn. You've got to you have to pick a price and stick with it. I'm not a chart person. That's the thing. You guys look at, you know, when you look at a chart and you go, oh my God, how can they call a bottom here? I'm not calling the bottom because of the chart. I could give two shits about the chart. I care about the value that the chart represents. And so when we're down 10%, we have made an adequate correction in the S&P 500, which is the main thing you care about, And the S&P 500 coming into earnings, I believe, will justify, where are we now, 1920. I believe 1920 is justifiable on first quarter earnings. We'll find out if I'm right or wrong. But because I believe that, and because timing-wise we're coming into earnings, and starting Thursday and Friday, you're going to hear from a whole bunch of S&P banks, which is one of the sectors everybody's worried about, the relief that we could get on Thursday and Friday can knock us back up 5% real fast. And that's how I look at the market. Purely fundamental. The charts are just completely incidental to what I'm doing. All right, that's a good place to leave it off. We will come back next week and see if I was right or wrong. All right, thanks everybody for coming, and we'll do this again next, I'll say Tuesday, but we are thinking of changing the seminar to Wednesday unless we have huge objections to it. I just liked it last week. Last week we did a Wednesday seminar. I liked the way it broke up the week a lot better for me. So we are probably going to change our basic webinar date to Wednesday, either next week or the week after. That's most likely what's going to happen. All right, but thanks for coming, everybody.